In this video we are going to talk about the top 10 ways to earn $500 a month with these dividend stocks. Before starting this video, please like this video and subscribe to this channel for future updates. In today's low interest rate environment, retirees are increasingly relying on stock dividends to supplement their income. Stock yields are frequently higher than interest payments on investment-grade bonds, making such a move appealing. However, dividend investment carries a risk. Companies can reduce their dividends when times are rough, and when a company reduces its dividend, its stock often drops as well. When establishing your portfolio, look beyond the headline yield numbers to improve your chances of having that income flow in on a constant basis. The good news is that you can still get there by following a relatively simple procedure. Here are the top 10 ways to earn $500 a month with these dividend stocks. Number 10. Northwest Health. Northwest Health's yield isn't as high as some of its peers, but at 6.9%, it's still a good deal for investors. What's nice about this company is that it provides a lot of diversification for investors and has seen a lot of recent growth. Sales increased by more than 130% from $150 million in 2014 to $350 million this year. The REIT provides an excellent option to invest in healthcare, which is something that most REITs do not provide. Northwest also has a portfolio of assets in various regions of the world, so it isn't simply investing in the domestic market, which adds another layer of diversification to your portfolio. Northwest has a low level of volatility, making it a good dividend stock. It has been trading in a limited range of above $9 and below $12 over the past 52 weeks. This constancy can help you prevent big swings in the value of your investment. Number 9. Hydro One. Hydro One has the lowest yield on the list, paying 4.4% to its shareholders. And it's here to assist balance out the other stocks and provide some more diversification. The utility stock is an excellent alternative that hasn't been very volatile, especially given the Ontario government's involvement and all the politics that has accompanied it. Despite this, it is a reliable utility stock with a consistent inflow of customers and income. It's a good investment because it's only 1.4 times its book value. Investing $22,000 in this company will provide you with $81 in monthly dividends, which will help you get the rest of the way. Moreover, despite the fact that the stock is still relatively new, it has already increased its dividend payments since being listed on the TSX. If this pattern continues, you may be able to create even greater cash flow in the future. Number 8. Boston Pizza Royalties. Boston Pizza Royalties is a high-yielding dividend company that pays an annual dividend of 8.3% to investors, and because payments are paid on a monthly basis, it's a terrific method to build up a lot of consistent cash flow. The fund has dropped 17% in the last year, which contributes to the high yield. However, because you're effectively betting on one of the country's best restaurant chains, it's not an investment I'd be concerned about in the long run. There's a chance the stock may recover, but in the meanwhile, this is a wonderful opportunity to lock in a high yield. A $36,000 investment in this market would yield slightly under $3,000 a year, or $249 each month. The company is currently trading slightly above its book value, making it a terrific buy for investors searching for a bargain. Number 7. Choosing the right stocks. First and foremost, you must ensure that you are selecting the appropriate investments. Dividend stocks aren't all created equal, and picking the wrong one could result in you losing more money than you make. The dividend yield is a crucial consideration. This is the amount of dividends paid out in relation to the stock price. A higher dividend yield is usually preferable. But don't forget to analyze the larger picture and the company's overall financial condition. It's a bad warning if the dividend yield is high yet the payout ratio has been steadily increasing, for example. Although it varies depending on the individual stock and industry, the average dividend yield is roughly 2% to 3%. It's not always a bad thing if a stock has an abnormally high dividend yield. However, you should do your homework to ensure that the firm is stable, as higher than average dividend rates aren't always sustainable. Number 6. Invest with an eye toward diversification. With those first 5 stages, you should be able to narrow down the universe of qualifying businesses to a manageable number. You'll actually develop the portfolio that will allow you to make that revenue in this step. Examine the industries and business lines of the companies that pass your standards and choose those that don't compete in the same markets. Try to find a group of 20 companies in various industries that all appear to be worth owning based on your other criteria. Purchase them in roughly equal quantities until you have enough shares to generate the $6,000 per year of income you desire. Diversification won't prevent terrible things from happening to your portfolio, but it will lessen the impact of any industry or company-specific issues. That way, if something goes wrong, you'll have a better chance of sticking to your overall goal. Number 5. Seek out companies with decent dividend track records. Dividends are voluntary payments, with the exception of some businesses that are required to pay them due to their structure. Companies that commit to paying a dividend on a regular basis tend to prioritize it and plan around it because it consumes a significant amount of cash. Once that money has been committed to the dividend, the corporation can no longer utilize it to expand, pay off debt, or manage its business. Company executives are aware of this, and they also understand that investors who have become accustomed to a dividend are more likely to want to see it continue. As a result, businesses that establish a solid track record are more likely to desire to maintain that track record. They'll structure their strategies and cash flows to increase their chances of providing that payment and to protect it as much as possible. It's still no assurance, but it gives reason to trust that if a corporation can, it will support the dividend. Number 4. Insist on a solid balance sheet. A dividend will be paid from the company's cash flows during good times. During difficult times, a business may require every penny it can make, plus more, just to stay afloat. For its dividend to be sustained, it must have a strong enough balance sheet to meet its costs and reward its shareholders even if its cash flow is temporarily reduced. That's a difficult task. It can nevertheless get through a short-term hard patch if it has enough cash on hand and other current assets to fulfill the expenses owing. It can also boost its chances of making it through protracted struggles by having enough long-term assets compared to its long-term debt load so that lenders are prepared to roll over maturing debts. In any case, since dividend payments are never guaranteed, a strong balance sheet increases the chances of a dividend being paid when things go wrong. Number 3. Look for a Goldilocks payout ratio. Dividends deplete funds that could otherwise be utilized to maintain or grow the business, according to the corporation. When circumstances go rough, a payout that needs too much of the company's capital hurts the company, which could lead to a dividend cut. On the other hand, if a dividend doesn't use a significant amount of cash, it could indicate that management is concerned that it won't be able to support a greater payout. As the corporate environment changes, this can also suggest a danger of layoffs. A payout ratio in the Goldilocks zone of 1/3 to 2/3 of cash flows demonstrates a healthy mix of commitment, confidence, and flexibility. While this isn't a guarantee that a dividend will be maintained when times become tough, it is a sign that the firm values its dividend and has built in flexibility to deal with the unexpected. Number 2. Decide on your minimum yield. If you're seeking for a way to generate income from your investments, you can select between stocks and bonds. The benefit of stocks is that their dividends and share prices have the potential to increase over time, potentially resulting in higher income levels. Bonds have the advantage of being higher priority, which means they're more likely to be paid when things start to go wrong. Because the purpose of this exercise is to generate $500 in monthly income, you might want to start by looking at equities that yield more than long-term Treasury bonds. 30-year Treasuries recently yielded 2.45%, so screening for companies with stock yields of 2.5% or greater might make sense. After all, Treasuries are one of the safest investments available. If you're looking for a steady stream of income, you can get at least that Treasury rate by purchasing Treasuries. Number 1. Annualize that monthly income and plan around that. A $500 monthly payment equals $6,000 each year. Rather than a monthly target, you should strive for that annual revenue level. Many businesses only pay dividends 4 times a year. It's difficult enough to locate firms that look worthy of purchasing because you need to focus on dividend quality rather than quantity. You don't want to risk a good investment by forcing yourself to buy a less robust company just because the dividend is paid at a more convenient time. If you invest in a traditional brokerage account, you can request that your dividends be sent to you in cash. Many brokers will also be present. What are your thoughts on our video? Do you have something to add to our list? Please let us know in the comment section below. If you enjoyed this video and would like to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.